Hey there, and welcome to Real Investment News. I'm Mike O'Neill. You know, there has been a lot of talk about China and trade deficits, but how does the U.S. stand when it comes to global trading? Well, this morning I told you how the U.S. balance of trade report showed our trade deficit was growing, and now I want to take a closer look at the numbers. First, here's the headline. The U.S. trade deficit, which is the difference between how much we export versus how much we import, it actually widened to $57.6 billion in February. Now that is from a revised deficit of 56.7 in January, bigger than the market was expecting, and once again, this is the biggest deficit that we have seen since October of 2008. Now, let's split this up. The good news, total exports rose 1.7% to an all-time high of $204.5 billion. The bad news, the total imports also increased 1.7% to an all-time high of $262 billion. So with which countries do we see the biggest trade deficit? Well, if you guessed China, you would be right. In February, our deficit with China was $34.7 billion, which is actually a drop of about $0.8 billion, by the way. The EU, Germany, Mexico, and Japan are in the top 5. We actually have trade surpluses with South and Central America, about $3.4 billion, Hong Kong, Brazil, the United Kingdom, and Singapore, but these surpluses, as you see, are much smaller than the deficits. Now, the problem with having a big trade deficit like this is that it can pull down the GDP, and right now that is already expected to drop below 2%, down from the 2.9% average we saw for all of 2017. And that means you can expect to hear a lot more from the administration about their plans to fix the trade deficit, especially with China through those tariffs, which, as we have seen this week, makes investors really nervous. That's it for now. Thank you so very much for watching. Please remember to follow us on Facebook, Twitter, YouTube. Check out our past reports at realinvestmentnews.com. I'm Mike O'Neill, and we'll see you again tomorrow morning.